Hi, I just wanted to go over some of the examples that are very similar to the journal entries you are required to do for week 7's homework assignment. So we are making adjusting entries. Your company is now ready to close the books, and as of end of the year, we are making some adjusting entries. In addition to some of the items that were shown in the book, um, actually there are more entries that we need to make. So next 10 examples are common journal entries we may need to do at the end of the year before we close the books. The first one is about inventory. This is the simplest way of handling inventory. We are assuming that this company has been just accumulating inventory and keep adding inventory on inventory account, but never have taken out any cost of goods sold. As you know, when we sell our merchandise to a customer, that particular inventory has taken out from the warehouse and it has been given to the customer. So that value of the goods that was sold should be recorded as cost of goods sold and also must be taken out from our inventory. So simplest way of handling it is just simply increase cost of goods sold by debiting it and decrease inventory at the same amount. Number two is about unearned fees. Some of you may haven't seen this account before. Unearned fee is a liability account. It demonstrates an occasion when a customer gives the company cash in advance before we deliver any service or product. So we have received cash before we provide the service or product. Therefore, this cash represents liability and unearned fees is a liability account. So during the month, or actually on this case on July 1st, 2016, this customer gave our company $12,000 for 1 year service. So since it is now December 31st, only 6 months has passed and we have not delivered 6 months service. So the remaining 6 months will be delivered next year. So at first it was $12,000 as shown as unearned fees, but since we have delivered half of the 12 months service, we should reduce that amount by 6,000 and recognize revenue now. So it is time to recognize revenue for 6 months and at the same time reduce the liability account, which is unearned fees account, by 6,000 as well. So when revenue goes up, it goes on credit, right? Normal side for revenue is credit side. And unearned fees, which is liability account, it is normal on right hand side, which is credit side. But since we are reducing that balance to 6,000 from 12,000, 6,000, we need to debit it so that it will go down. So unearned fees used to be 12,000 on the right hand side. Now we are debiting it so that it will become 6,000 only. At the same time, we are recognizing revenue 6,000. The next item is about prepaid insurance. Whenever you see an account name that starts with prepaid, that means it's an asset account. We have paid another company in advance. So in this case, our company paid insurance company in advance certain amount. So since that other company did not deliver their service or product to me yet, that means that cash I paid to that company is an asset account. So when I made the insurance payment, for $2,000 for 6 months in advance. That's an asset account for our company. So in this case, we said we pay for 6 months on October 1st, 2016. So now it is December, so it has been only 3 months, right? October, November, December, 3 months has passed. But I pay for 6 months insurance expense at that time. So 3 months out of 6 months has expired. We already used it up. Our insurance expense has incurred during that time. So now it's okay to recognize that expense. So we will recognize 1,000 out of 2,000 because of the $2,000 of 6 months insurance advance payment, only $1,000 has been expired, meaning we used it up, meaning that 3 months has passed. So now, as of December 31st, we're going to recognize insurance expense by $1,000, representing 3 months of insurance expense. And we're going to reduce the prepaid insurance asset account to $1,000. So before I made it $1,000 entry here, the prepaid insurance asset account must have shown $2,000 on the debit side here. So now I'm going to reduce it by 1,000, so it will become only $1,000. Next one is about equipment and depreciation. We learned that when we acquire new equipment, we don't expense it, but we capture it as a capital asset. Then we slowly and consistently be depreciated over its useful lifetime. So in this case, it says we have acquired $62,000 equipment. It has salvage value of $2,000. So 62,000 minus 2,000 would make 60,000 depreciation base. And its useful life is 6 years. So since we're using straight line, 60,000 divided by 6 years would make it $10,000 a year depreciation expense. But since we purchased it on July 1st, when there has been only 6 months in 2016 since we acquired this equipment, we could only depreciate the half of it. So 10,000 divided by 2 would make $5,000 for 2016. So next year, of course, we could depreciate entire $10,000. But for this year, we will only depreciate $5,000. So depreciation expense goes up by $5,000 and accumulated depreciation goes up by $5,000. Number 5. Employees have earned $3,000 of wages not paid on December 31, 2016. This scenario is very common because we do not pay our employees right then when they earn their wages, right? Companies usually hold at least 1 week or 2 weeks of wage, and they don't pay their employees right away. So on December 31st, 2016, although my employees have earned $3,000, we do not pay it yet, and it's the end of the year. So our company probably will pay this amount sometime next year. However, we want to capture that expense. So we're gonna increase debit, salary expense $3,000. At the same time, we have to increase the liability account, salary payable, because we need to remember to pay our employees next year. So expense captured by increasing expense account and payable is recorded on the credit side, so we could pay next year. Number 6, the employer owes $1,500 employment tax on wages not paid at December 31st, 2016. Again, right now we are just assuming $1,500. That's our employment tax that's owed by the employer. We are not considering the amount that was withheld on behalf of employees. So assuming this is our employer's employment tax expense, we need to capture that expense. So at the end of the year, we are not going to pay the government that payroll tax expense yet. However, we will capture it for our financial statements. So we increase tax expense and we also increase tax payable account. Number 7 talks about uncollectible accounts. This is something based on estimate. However, the accrual basis accounting method requires us to do this. You cannot skip it. If your company has some type of uncollectible accounts and you could reasonably estimate it, you should make a reasonable estimate and capture it. So in this case, the company estimates it as 1.5% of the year's sales. So at the end of the year, they realize they have $3 million sales. So 1.5% of 3 million sales would make it 45,000. So to record it, we increase that expense. So this will be type of expense that's going to reduce your revenue. And at the same time, we are using this special account called allowance for doubtful accounts. Some of you may haven't seen this type of accounts before, but this is account that we use to record the uncollectible accounts, the estimated uncollectible accounts. So when you do that, you increase this account is normal on the credit side. So allowance for doubtful accounts is normal on the credit side. It goes up on the credit side, and we call this contra account. It is a contra account to accounts receivable. So when we provide it on a financial statement, you will learn later that we will have accounts receivable balance minus allowance for doubtful accounts. So you will net it out and we will show only net amount. So again, this is the way we record the estimated uncollectible accounts. Number 8, prepaid rent. Again, whenever you see prepaid, that means it's an asset account. So since we made a prepaid rent expense on October 1st, 2016, we need to make some adjustment toward the end of the year. So whatever the expense that should be captured as of December 31st, we're going to capture it. So 20,000 was for 6 months, and only 3 months has passed since we paid that prepaid expense. So 3 months is worth 10,000. So we're going to capture only 10,000 as an expense, and the remaining should just stay as a prepaid rent expense, which is asset account. So asset account goes up on the debit side. So prepaid rent expense must have been sitting on the debit side, 20,000 here. But we make a credit entry to the right hand side, this prepaid rent expense balance will go down by 10,000 and it's gonna just stay as 10,000. And then rent expense goes up at the same time. Number 9 is about supplies. Supplies could be either asset account or expense account. Many of us just consider supplies as expense all the time, but the proper way of recording supplies is when you first purchase the supplies, you record it as asset account. So you will have supplies on the debit side. At the end of the year, you do the inventory of the supplies. And when you find out that you used up certain amount, that's when you capture the expense, supply expense. So in this case, we purchased $6,000 at one point, and we had that amount just sitting there, and we are assuming that nobody made an adjustment on that account. At the end of the year, we found out 500 was remaining in the supplies room. So that indicates we have used up 5,500 worth of supplies. So therefore, we could now capture the supplies expense. So we are capturing it by increasing expense account and decreasing asset account. So that asset, supplies asset account, will have now only 500 remaining on the left-hand side. Number 10 is the final one. It's about interest expense. It says that our company borrowed $10,000 on a 2-month note payable dated December 31st. I mean, December 1st. So it is now December 31st. So it's been only 1 month since we borrowed this money. And the note is not due yet. Note will be due next month. So in January 2017, the note will be due and I need to make interest payment. So the way we calculate interest is usually when you see an interest rate, that's an annual interest. So it's never like half year or quarterly. Whenever you see unless they really indicate it clearly. So usually when you see an interest rate, that's annual rate. So what it's saying is 6% is annual rate for 10,000. So 10,000 times 0.06 makes $600. That's 1 year interest expense. However, I'm only borrowing 2 months, and also right now, as of now, it's only December 31st. And since I borrowed it on December 1st, I should only capture expense for 1 month. So 600 divided by 12 months makes $50. So $50 represents 1 month's interest expense that I am not paying it yet, but I will be paying next month. So therefore, I'm capturing it as an expense and capturing it as payable.